slowing growth. Inflation, not just a problem here in the US, but also taking its toll in Europe as well. The European Central Bank on Friday said year-over-year inflation rose 8.6% in June. The ECB is expected to raise rates for the first time in 11 years later this month and is projected to add another increase in September. In other news, Meta CEO Mark Zuckerberg is warning employees to brace for what he believes, quote, might be one of the worst downturns that we've seen in recent history, quote, something we're going to unpack with our guest just a little bit later. And Kohl's down sharply after confirming it has ended sale talks with the Franchise Group, the owner of Vitamin Shoppe. Franchise Group had lowered its bid for the retailer to $53 a share after initially offering about $60 a share for the company. Additionally, Kohl's trimmed its financial outlook as it prepares for weaker consumer spending trends. And shares of semiconductor company Micron are down after the company issued disappointing guidance, saying it believes smartphone sales will be lower than expected for the rest of 2022 and that PC sales could decline 10% versus last year. So with that, let's bring in our guest, Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Thomas, thanks for joining.
Thanks for having me, Anne. Great to be on.
So, Thomas, general sentiment, we saw closing out the first half of the year very negative, but as we go into the second half of the year, what are your thoughts on where the market's heading right now?
Yeah, well, I think there are a couple of things we need to focus on, Anne. One thing that happened yesterday, which is kind of bad news, good news, is the Atlanta GDP now number for Q2 slipped to negative 1%. That number tends to be a little more pessimistic than the actual numbers come in, but if it's accurate, that would be the second consecutive quarter of negative GDP, which would mean that we've technically had a recession. That's the bad news. The good news is the market is a discounting mechanism, and the question is what magnitude has already been priced in. And we would assert that a mild recession has already been priced in, a severe recession has not, and we're more in the camp that it will be a mild recession moving forward based on earnings, based on outlook, and based on the data that we're looking at on a day-to-day basis.
So just to unpack that a little bit more, Tom, the first half has been very tough. When you look back historically, has the second half of the year had strong correlation with the first half of the year? So said differently, is the fact that the first half, that it's been so negative, can we expect any relationship to that negativity coming up in the second half of 22?
Well, I think that history will support that brighter days are ahead, Anne. If you look at the last 5 times this has happened, i.e., we've started the year down over 20%. On average, the second half rebounds by 23.6%. And the big headlines in the last 48 hours are that this is the worst start to the year in 50 years. Since 1970, for stocks and bonds, the markets were down. S&P was down 21% the first half of 1970, but it did rebound over 27% in the second half. So while we're not wholesale buyers of the general indices, we are seeing a lot of great high-quality franchises that are on sale that we want to start to leg into with a long-term view. And when we look back 3 years, 5 years from now, we'll look back to mid-2022 and say, my goodness, why didn't I buy more of XYZ? Why didn't I buy more of Amazon? Why didn't I buy more of Meta? Mark Zuckerberg always figures it out one way or another. If you remember, he had the mobile debacle because he was all focused on desktop, but he figured it out. Then you have the Apple privacy, he'll figure it out. So a lot of high quality franchises are on sale, but we've actually taken our focus, Anne, abroad, and we've been aggressively talking about, and may have even mentioned on the last time that we were with you, that what's happening in China is an entirely different story. So while the rest of the developed world has been aggressively tightening policy, trying to drive down consumption to control inflation, which, by the way, they're being successful on that front, if you look at the recent data points since April, China is the only large economy besides Japan that's been aggressively easing and stimulating their economy coming out of the lockdown. And as a result, you've seen a massive rebound in the China indices and particularly China tech stocks. The indices are on the verge of a new bull market. They're up almost 20% off of their lows. And companies like Alibaba, which is our largest position, are now up 45, 50% off of their March lows. So like the great financial crisis, we think that China has bottomed before the U.S. in the great financial crisis in 08 and 09. The China indices bottomed about 4 months before the U.S., and the China indices have bottomed in March, so maybe we can expect better things over the summer from the U.S. indices, if history is any guide.
Tom, can we unpack that together a little bit more? Because a lot of Chinese production historically has been destined for exports, and we talked in the opening comments, Europe's looking at recession fears, the US is talking about recession, so the demand for Chinese product internationally may not be there. So as you look at Alibaba, which is like the Amazon of China, are you focusing on Chinese companies that are domestically oriented, or are you still bullish on those that are export-led as well?
Yeah, well, Alibaba's predominantly focused on domestic consumption in China on their retail end, and even on their web services, i.e. their cloud business, which is growing like a weed, is predominantly focused on domestic consumption. And that is a core initiative of the Chinese government coming out of the lockdown, is to stoke massive consumption to recover their economy. So Alibaba is going to be a major beneficiary. About 1 billion of their users are domestically in China, and they are growing aggressively outside of China with about 400 million users in Southeast Asia. So the export story to Europe and to the United States is much less of a concern as it relates to Alibaba.
Tom, speaking of tech, let's talk a little bit about Mark Zuckerberg, CEO of Meta. Just to repeat the comments he made to his employees yesterday, he warned, quote, "This might be one of the worst downturns that we've seen in recent history." Recent history is pretty short, but tell us, Tom, what are your thoughts on his comments, and how would you frame the timeline that he was perhaps referring to?
Well, look, he's being opportunistic. They're spending a lot of money on this metaverse initiative. Part of that is because he believes in the metaverse. Part of that was to change the name and change the focus from Facebook, which was getting a lot of regulatory pressure about the, quote, ills of social media, etc., and the antitrust threats from Europe and the U.S. So they diverted focus. They started spending a lot of money. And what they're realizing is, with everyone talking about recession, this is as good a time as any to kind of, trim some staff that are maybe found to be redundant. A lot of these companies, not just Facebook, during the pandemic, they figured something out, which was a lot of their management or middle management were significantly less productive than they had thought when they were coming into the office. And they're using an opportunity to kind of trim down. But you'll notice that, even in the case of Tesla, while they're trimming down middle management because they found them to be less productive during the pandemic, they are, on balance, adding at the entry levels and adding at to grow the business and to grow the future. So I think it's a mixed bag here. I think Zuckerberg is doing the right thing, as he always does. He goes through these phases, these cyclical phases, and he comes out stronger with a greater moat. If he can't compete, he'll just either take the idea and copy it, or he'll wind up buying it, and he will maintain a moat around the business, which is still the greatest advertising platform ever designed by man.
Big, bold statement there, Tom. I'm inferring that you're perhaps a small fan of what Mark Zuckerberg has built over the years. Let's just finish up by touching on something that you alluded to, which is if people can't build it, perhaps they'll buy it. Closing question for you this Friday, rolling out the week with us. Do you anticipate that there will be more tech acquisitions, and if so, where do you see that happening?
I do think there will be more tech acquisitions, but I would say, and the greatest opportunity right now in our view in terms of acquisitions is going to be in the biotech sector, not the tech sector. And the reason is pharmaceutical companies have record cash on their balance sheets. They have patent cliffs coming online, and they've got to deploy that cash to buy innovation to keep their growth going. And biotech stocks, by any metric, whether it's price to operating cash flow, price to book, price to sales, they're trading at multi-decade lows. And you've already seen the first 5 deals in the last month or so. Pfizer taking out Biohaven for $11 billion. Glaxo did a deal, and on and on. Animal spirits are back in the sector. The boards among large pharma across America have been put on notice. If you don't start taking these acquisitions, your competition is. And we've seen a nice bounce off the bottom from biotech, but I think we're going to see some follow through over the next 2 years. And the biggest bearish thesis has been biotech can't go up when rates are rising, and that's patently false, because if you look at one of the biggest moves ever from 2016 to 2018 when the sector was up 140%, the Fed funds rate went from 25 basis points to 250 basis points during that period. So I think there's a really hidden treasure there in the biotech sector, and buying a large basket may be a prudent way to go. It's certainly what we're doing as our second largest position.
Tom Hayes, great insight for all of us from you today. Thank you so much for joining us. Thomas Hayes, Chairman and Managing Member of Great Hill Capital. And that will do it, folks, for today's session of the Open the First. This month, the opening bell is here, and now you're armed with the markets information you need to start the day. Tune into the Open on Public Live every Monday through Friday at 9:15 a.m. for Daily Market Snapshot, and also have